Oh, I'm sorry. I'm sorry. The first few slides didn't record there. So we're on Ian's question about setting up a synthetic married put on power options, and my idea is to use the bull put credit spread. So we'll go into bull put credit spread and we'll go into search. Naturally, our defaults are going to come up. If we see the bull put weekly come up first, that's usually the criteria I use. Let me get this out of there. There we go. Yeah, weekly bull puts, it's usually the criteria I use for the positions I open on Monday afternoon. But what did we want? We wanted something 2 weeks out in time, roughly, August 16th, about 14 days, based on Ian's question. I wanted a bull put that's sort of close to at the money, where the short option is at the money, and the long option that I'm buying is slightly below it. And then we'd add the long call in later. So I'm just going to clear out the filters from the defaults. I'm going to keep the expiration time frame the same, 8 to 17 days, so we're going 2 weeks out. I'm not going to worry about net credit or return, but what I am going to focus on is at the money. I'm going to force it to be less than 1 strike out of the money and less than 1 strike in the money. That's always looking at the short option in the spreads, the pivot point of what's most important. Now, I might look for some volume to make sure there are some good contracts out there and some good open interest so to see some activity. But I'm not going to worry about the delta. I'm not going to worry about anything else, but I'm going to keep the strike difference around $2. That was base suggestion from Ian. So I'm going to put the strike difference equal to $2 for our August 16th expiration. You could change that to 5 depending on what structure you wanted to use. Then we just put in some basic bullish criteria. Stock price is irrelevant because we're using a synthetic. Might look for something that has a good earnings per share growth. Even though it's a married put, I might avoid stocks that have earnings between now and expiration as well. In the technicals, I might look for something simple, such as the stock trading above a 20-day or 50-day moving average. Since we're just going 14 days out time, I'm going to use the 20-day moving average. And average stock volume here, I want to see something that's traded. This is measured in, evenly traded, I should say. This is measured in thousands, so let's look for anything greater than 750. And I could put a MACD or Bollinger Band in as well. Let's keep it simple. Let's go ahead and run the search. Typically, I'd want to be slightly out of the money here. And I'm sorting it by return, so it looks like those are there. So let me change this to sort by, I'll just change the sorting. Instead of return, yeah, there we go. So here's a decent one, Western Union. Not saying this is a recommended trade or anything, but looking at the 2182 stock and going at the money with a 21 or 22 strike and buying the 19. But remember, we want to create a synthetic position. I'm just seeing if there's something a little bit better here. Oh, there it is. I want to use this one actually, the Western Union here. No, I'm going to, sorry folks, I'm going to stick with this one, the 21, because it's slightly out of the money. There is the 22 lower down here, so that's an interesting one as well. In any case, now that I've got it, I'm just going to go to bull put credit spread. We're going to go to the profit and loss chart. And we've got our basic bull put credit spread, of course. There we go. It doesn't offer a lot of return right now, but remember, we're not looking for a bull put spread. Now what I'd simply do, let's go to our August 16th expiration. And we're going to add the 21 call. I'm going to buy 1. And there we have our synthetic married put position with a risk of 285. Maybe a little bit high for what Ian was looking for, but that I think is the easiest way to go about sort of creating a search here. If there's a strategy that's not available in the 23 different strategies. So if I go to other strategies, you see we've got all of the vertical spreads here, credit spreads, debit spreads, calendar spreads, calls and puts, covered calls, covered combination, that's doing a covered call and selling a put against it, covered put position, iron butterfly, condor, buying calls, buying puts, collars, straddles, strangles, married call, married put, naked call, naked put, and so forth. So we could straddles and strangles as well. But if at any time you're looking for a strategy that is not available, well, break down the structure of that trade. If you're looking for ratios or synthetics, if you're thinking about a synthetic covered call, selling a put, buying a call, and then maybe selling an out of the money short call on the same stock, I'd look at that just as a bull call debit spread with a short put. So I'd use the bull call debit spread search, go to the profit and loss chart as we did, and add in the short put as well. The synthetic married put, we just covered that. I think it's easier. You could use the married put search, but then when you link to the profit and loss chart, you'd have to go ahead and take out the stock and add in the short put and the long call in that case. Okay, so I think it's easier just to use the bull put and add the long call. Now, if you're doing a ratio, back spread or other, then I would consider doing it as the credit spread or the debit spread search, and then add the extra option when you go into the profit and loss chart. All right. So Ian, that's what I would consider going through this as well. Now, Mark asked a question related to this before we go to our next email, and I did see other questions from David, Sam, and Binh. I'm going to get to you all in a minute. We're just going to have another 5-10 minute conversation. It might be actually longer than that, related to Ed's question that was sent in earlier. But Mark's question is sort of related to this. He says, does that strategy, the synthetic married put, indicate likely collateral required? Well, again, if I'm on the profit and loss chart, that risk that you showed of 285, the way we structured it is as a bull put credit spread and paying the cost for the extra long call. The collateral that's required here in this structure, Mark, the synthetic married put, is only the bull put credit spread plus the debit that was paid. All right, in this case, that was 85 cents. So let me make sure you guys are seeing back on the profit and loss chart. There we are. So for this structure, Mark, when I just did the bull put spread, and then I've got the cost of our extra long call, we have a $2 monetary requirement between the strikes. The net debit total was about 85 cents. We got 10 cents credit on the bull put. Like I said, might not match Ian's needs. And then the 95 cost for the long call. So the maximum risk and requirement is 285. I've had to put up the $200 for one contract, margin requirement, and then beyond. But to answer your question directly, if you were trying to structure in the custom spread tool the synthetic position first, your collateral is simply the naked put structure. It shows you a cash secured naked put. That would be your synthetic long stock. I'd have to put up the money in this case to cover cash secured put. If you're using margin, that's a little bit different as well. So that's what we're looking for there. But then in this case, remember, we still have the cost. We'd get 13 cents premium from the naked put sell. We'd have $95 payment for the long call. So we'd have a debit of 82. So total requirement out of pocket would be 2182. And the risk, of course, is 2182. If the stock goes to zero, I'll lose the full amount on the naked put and on the debit of the long call. Quick follow-up to that. This is not really follow-up for that. But Ray asks, is this an appropriate time to ask for a demonstration how to set up the portfolio? It absolutely is, but I take the questions in order. So we're going to go through our other question next. Then we've got Binh, David, and Sam, and then we'll get to your question, Ray, in just a moment. Okay, so let's go ahead and toggle back over to our slides. That's just how to set up some of the searches you might use for synthetics or another strategy. Now, Ed's question can go either way. The answer can go either way. It's kind of a preference. And I think I've talked to Sam before during these webinars about his preference for recording purposes. But Ed said, I was wondering how you could go through to calculate profits and losses on rolling a spread or single option. He says, it seems if it's a loss or a gain, that becomes real rather than paper, and the new options start just as there is no roll. Is that correct? Well, in a sense, you could look at it that way. So I sold a naked put. Let's say the stock fell. Let's say I sold it for $1. The stock fell. My naked put was 2 points in the money. I decided that I thought the stock was going to recover. So I buy it back for $2. I roll a month or two out and down in strikes, and I get $2.25 in premium. So now that you've closed it, you can say you've realized the $2 loss, and you're hoping to make $2.25 on the position that's 60 days out in time as long as it expires worthless. And then as you look through your track record or on PowerOptions, you'd look on the analysis tool, Ed, and it would show you that for that particular stock, as you were rolling puts down, that your total gain or loss was 25 cents or $25 for just one contract. You could do it that way. In my mind, personally, I prefer to account for the loss on the position if I roll a spread, which I don't always do. Let me comment on that first. Just like we showed the bull put credit spread before a moment ago in the context of a synthetic married put. But if I'm tracking my bull put spreads in the portfolio and one goes against me and I decide one of the 8 ways I could manage the bull put spread is just roll down the spread. In general, I don't choose to do this. Simply roll down the strikes and maybe roll it further out in time to keep in a bull put spread. And the reason why is that I was already wrong. I got into a bull put spread, the stock changed and now is showing a bearish trend, even if it's further out of the money, even if it still has a low delta or probability of 75 or 80% of expiring worthless. If the trend is showing me downward, I likely close that bull put spread for a loss and maybe move to a bear call spread or just accept it. That's one of the 15% losses with about an 85, 83% success rate I'm going to have over the year. That's just one I'm going to chalk up to being of the 15 that are going to be a loss. And I'll actually look for a new position in that strategy rather than just continue trying to roll a position that's moving against me, keeping the same sentiment. Okay, so I account for the loss myself. But it says, he continued on, it says that once you sell the existing position to buy the new position and roll, gains or losses from the existing position become real, not paper, and you just start with the new position. But in my mind, I want to account for it. I want to know that even though if I rolled that spread down and I had to go 60 days out instead of 2 weeks out and got a $1.10 net credit, that I had to factor in the 90-cent loss. So I'm really only making 20 cents on this spread personally. So if that loss gets bigger than 20 cents, I might have to manage quickly because I don't want to let the loss on that bull put spread go to another 95 or $1 or $1.50. So then my total loss would be, say, $2.50 on the whole thing, right? I have to keep in mind what that is. So you can look at it either way. But personally, what I tend to do is take into account the loss on the initial position, take that away from the net credit, and I might even track it in my portfolio, reflecting the lower net credit so that I don't think, oh, it's okay, I got $1 for this new spread that I'm in right now, and right now it's going to cost me $1.20 to buy it back. So I'm okay, I'm only losing 20 cents on the premium that I took in. But in reality, I'm losing $1.20 because this roll was designed to help minimize the loss or repair the loss. And same thing with just rolling a single option. But you can choose to do it either way. It's up to you what makes you feel more comfortable. If you do feel more comfortable looking at the position as a realized loss and then just tracking the new position that you rolled to, I have no problems with that. I can't see any fault in that. It's what makes you comfortable and what you want to account for. But when I'm in the portfolio, if I go, let me look for something else here. I don't think I closed anything here. But when you're tracking a position, let's say I'm rolling spreads in my portfolio in the same stock. I know a lot of you tend to like to trade spreads or even option legs on just SPY, on Apple. Right? You continue the trade on Apple. You continue one strategy on Apple. So when I go to that analysis view, let me go last 5 years. When I go to that analysis view, what this tool does is it shows me all of the transactions. So here's, kind of bull put credit spreads on CMG that were rolled twice and then increased the number of criteria. So although I sort of got a good premium here and a good premium here, we did eventually make a profit on this position. This is fake, by the way. This is just the webinar account. This wasn't a real position. But I have a running tab. Goose as well. You see, we took a big loss here on one of these put adjustments. But the total loss is only $68 because we did profit on the first spread but lost on the second. So I have a running tab here. If I have a Goose bull put spread open now, I know that I need to make up the $68.90 that I've lost from the previous 2 adjustments on the trade. So I use this view to tabulate where I stand right now with my spread positions as a total view. But as I mentioned, if I'm in the actual portfolio, if I'm tracking a bull put spread that I rolled, or let's say a long call, I might not put in the actual price I paid for that spread or that long call. This might include gains or losses that were received if this is part of an adjustment, if it's a roll, for example, Ed. So I don't really know how best to answer your question because it comes down to personal preference. I do it sort of the way opposite of what you mentioned. I do account for it as a real loss, but I don't look at the next open position as a new trade. I may factor in the loss from the other one, so as I see it in my portfolio, I know exactly what I need to make out of the position. Not what I collected, the $1.10, $1.15 I collected for the new bull put, but that I took a dollar loss, so I'm only holding in at 20-cent net credit for this trade. And that's what, so when I have to manage it, if it starts to go against me, in that case, I know I can't let it get too much above that 20 cents. Not the dollar I originally received for the new spread. It's the 20 cents I'm focused on that factors in the loss from the previous position. Okay, I haven't read this all the way through, so I'm going to read it on the fly to everyone. And this is Binh's question. We're off of I apologize, we're off of the emailed questions now. We're on to the live questions. GoToMeeting sort of changed their structure of how you can scroll through the questions, so it's much harder to make sure I'm seeing the full material. But Binh wants to know, can I analyze this setup? Okay, buy shares. All right, so we're buying shares of stock. We're going to assume a 100 block. Buy protective at the money put, ATM put, and buy ATM long call, and then sell an OTM call. Okay. Duration long call to finance long put and long call. Can this be done? What are the pros and cons? Okay. So what I think you're doing is an at-the-money married put. Buy stock and buy an at-the-money put with a reverse calendar, meaning that you're buying, I think, shorter term, Binh, the same expiration as the at-the-money married put. You said long, but you didn't specify which one was longer. But the way you make this sound is that you're selling the call, the out-of-the-money call, further out in time. Okay, so let's just take Apple. We're going to add the stock in, buy 100 shares at current price. So I don't know what you mean by long. Let me scroll down here a little bit. Okay, so at first I don't mean if you meant long as in the buy or long as in longer term, and you're keeping the same expiration dates. Okay. Pause for a moment. Asotush said, for married put, isn't the probability of winning low? How do we get 85% win ratio with such trades? I was talking about the bull put credit spreads. When I mentioned that rolling the credit spreads for Ed's question, which wasn't related to married puts, it was related to bull put credit spreads or rolling a spread or single option, Asotush, that's what I was referring to. The bull put credit spreads that we track, that we use for those weekly screens, usually has about an 83 to 87% success rate. I think I'm at 83 so far this year for 2019 with the spreads that I've been doing following the bull put weekly screen. It's bounced around. It's gone up to 87. It's come down a little bit, then went back up and then came back down. That's all fine. Yeah, the first 3 months it was at a 94% success rate. In any case, that's what I was referring to, not married puts, bull put credit spread. Okay, so yeah, here we go. Okay, so there we go. Let's keep the 14 days. Binh gave me some clarification. Buy the at-the-money call and the at-the-money put. And then he's going to finance that by selling a far out of the money call. Let's just say the 215. Okay, so I'm buying stock, buying the near-term at-the-money put, which you know isn't a preference of mine, buying the near-term at-the-money call, and selling the farther out call. Why do I call that a reverse calendar? Well, it's because when you typically do a calendar spread, you're buying farther out and selling closer in for sort of a debit. Okay, and you get sort of this bullish profit and loss chart. Some people might call the poor man's covered call. Many of you know I don't like that term. Breaking just these two legs down, if I buy closer in and sell further out, I get more of a profit and loss chart like this. Okay, what's the benefit of selling the call further out? You get a much higher premium, which pays hopefully for these two options here. That's what Binh's looking to, maybe even at a credit. But remember what we looked at the very beginning. There was the at the money, oh, sorry about that. There was the time value decay curve, where you know that if you're 100 days out, you have a slow decay, 60, it starts getting better, 30, you get more time decay, and then the last big bit of decay happens in the last 15 to 20 days, okay? And so in this case, the problem I have with any structure, even though it's in this other structure, we could call it a covered call bin with an at-the-money strangle short term if we wanted to. But what I'm looking at with this structure is that it goes against the main constructs of options trading. Number one, we have the at-the-money bell curve, which typically defines we don't want to be buying at the money that has the highest time value, any part on the chain, any part of that expiration is the highest time value. This is where you want to be selling. You want to be buying out here on the wings, which has the lowest time premium. Okay, so you're selling out of the money and you're buying at the money. Okay, the second construct is when I'm buying, I typically want to buy further out in time to have less time decay work against me. And when I'm selling, I want to sell shorter term to get the time decay in my favor. So 3 parts of this 4-part trade go against those 2 general constructs of options trading. But let's take a look at what it actually does. Now, we want a little bit more. He wants it for 0 to no cost. What does that mean? Well, he's shelling out an additional, in this case, $9.25. Now, I chose the 215 call, but that's only at 703. So I tell you what, let's go to the 210. Out to November, see if we can get around that $9. Absolutely close to it. Okay, so this is the structure that Binh would use. The long stock, the at-the-money strangle, and then selling a far-out call out of the money, but almost pays for, 2 cents debit here at midpoint, Binh. All right, and what do we see? Similar to that calendar spread structure that I mentioned, where you sort of get this check mark profit and loss chart. This eventually will curve. Why? Because what any profit and loss chart is doing, Binh, is it's analyzing it based on the short-term expiration, 8/12. So what happens at 8/12? We're not going to see, if the stock stays exactly at the same price, you're not going to see as much decay in that short call as you expected. You're not going to start seeing a lot of time value decay on the short call, even though it paid for the at-the-money strangle, in this sense. But you're not going to see a lot of that until you get into the last 20 to 25 days to expiration. That's assuming the stock stays the same. Okay, it's going to start at 60 days, and then this is 100 days out, November. It's going to start at 60 days, and then 30. You're going to get more and more decay, but it's not going to happen. Why aren't you seeing that curve more that you'd expect with that reverse calendar? And it's because it's looking short term. Now, this does have a low risk based on the cost invested into the position. Pros and cons of it? Well, the pros are obviously if it's neutral here. I'm sorry, the pros are it still gives you unlimited upside and it gives you a low risk, and the maximum risk is only at 1 point. That maximum risk is low, but it's at 1 point. The cons of this, Binh, it's for 14 days only. Because what happens in 14 days if the stock is still around, let's say, 205? Okay, let's just check it. So at expiration, stock's around the same price, 205. It doesn't move too much. You sold this call for $922.50. It moved up a little bit, so the call is almost at the same price. You've got no gain on the short premium except for what you paid here. The put expires worthless. Your call has some value left, okay? But you're a loss here on this position. It didn't move. But you say, hey, I've still got all this $920 in, but it hasn't decayed yet. It's going to cost you too much to buy it back. You're not getting much gain out of it. So what would you have to do? Well, you'd have to stay in the position, which means you're going to have to shell out another $900 to buy the 205 August 30th call and put. And this is one of those things that I don't like about that reverse calendar, where you're selling the call far out in time and buying the call closer in, is because if it doesn't work out the way you want in the first 14 or 16 days, well, then what I have to do is buy this call again. So now I'm lowering the premium that I took in and still not seeing any time decay yet where I can buy it back reasonably. So it is a low risk, but this position is giving you the concept, and it gets lower. That's great. It gets lower as it goes down because the call is going to be deteriorating more that direction, but it doesn't go back to profit. Okay, it's a lower loss. It's not bad. It's probably only in the 200 range if it really fell down to 180 or so because of the call decay and the value of the put increasing, countering the loss on the call and the loss on the stock. But again, it does need a movement to get to break even. And remember, that's at the short-term expiration. If it doesn't do what you want in the short term, you're going to have to pay more money into this to increase the debit in order to stay in the trade and keep that structure as well. Binh, just looking at the profit and loss chart, he follows on, when is the best time to use this strategy? I say if you're expecting a 10 to 15% increase in the stock in the next 14 to 15 days. Maybe that's a bit extreme. Okay, so this is about a 5% gain. I need the stock to move up 4 points or so. It's about, 5% gain, a little bit around that area, but for 14 days. So that's why I said 10, is because that would put you in the profit level here. You still wouldn't get the decay in the call that you wanted. And if the stock really ramps up and goes up to 220 or 230, you're not going to necessarily be assigned because you've got the November call. You're not going to get assigned early. Is now the best time when the VIX is high? VIX is not that high in my opinion. VIX is higher, but it's not that high. It moved up today because of the tariff talk last night and some other news that came out, of course. But the VIX is 1761. That's high-ish, but over the course of the last 8 months, we've seen this. Every time there's talk of a new trade war, new tariffs, it goes up to about 1680, 1750, maybe even 19, pulls back down to 13, then jumps back up to 17. This, to me, is higher. But if other news comes out over the weekend, we could see this go up to 21, 22. Oh, sorry about that. But let me go back to the question here. Is it better to do this when the VIX is high? Well, only if you, I wouldn't even say it's related to the VIX. Sure, if the VIX is high, you're getting a better premium. But remember, the options that are further out aren't affected as much premium-wise, percentage-wise increase in premium, as the near-term ones would do. If the VIX is high, I think percentage-wise, you're going to be paying more for these two at-the-money longs you're buying with a high VIX and a shorter-term expiration. Then you'd see a percentage increase for the November, where it's expected volatility will settle down at some point between now and November. So if you were selling near-term, I might say, yeah, that might make sense to do it when the VIX is high to get the best bang for the buck, and buying further out, it's not going to be as affected, so you're not going to see as big of a percentage increase from the current move on the VIX. But again, that's all based on the short and long term. Just look at the structure, Binh. This answers your question. When is the best time to use it? If you think of the next 14 days, the stock's going to be up maybe 10 or 15%, not related to volatility or the VIX at all. That's what you need to happen. Otherwise, if it doesn't happen, if it falls, well, you've got a loss, but it's controlled. That's great. But if it stays in this area, if it's a neutral market, you're not getting any kind of decay in time value. And to stay in the position, you're going to have to add another $900, buying the next at-the-money call and at-the-money put. So this is going to dip down further. And the break-even is going to move up higher because you still haven't gotten enough decay to buy it back. This is solely based, I'd say, on an 8, 10, 12, 15% movement upwards in 14 days. Might be some other strategies that are less capital comprehensive to do this with, if that is your expectation of a stock moving up 8, 10, 12, 15% in the next 14 days or so. Okay. All right. So that's how I'm going to answer that, Binh. Sam's comments, I'm not sure if he's still here, but Sam comment is best trades. First of all, he says, hello, everyone. It's good to be back. I was busy last Friday. Best trade was pins. I took the calls. It was $30.95, and I closed it this week when it was at $34. Okay. And Okay, so that was his only comments there. So we're going to move on to David's questions now. David's question, I'm sorry, David. It's one question, but it's also one that I have to read all at once here. So we're going to read it together for the audience and for ourselves. Let's see. All right. And then Ray's question. Okay, there we go. Pins was a 20 contract. Sam came back in. Okay, great. David. A covered call question. I entered a 4-week in-the-money covered call with downside protection of 4%. Premium he collected against the position. So we're talking about a covered call, of course, here. He sold an in-the-money. Got 4% downside protection and 2% return if assigned, I believe. Now, the stock drops through your 4% downside and continues to drop. What adjustment technique would you recommend? Rolling down or just close this trade? Other side, and the time value and the remaining trade would have a lot to do with the action take, just as we just talked about in that case. All right. So first, I'm just going to go to the search. And it doesn't matter what position you use, David, excuse me. I'm just going to go with the in-the-money default. You said 4 weeks out. So this is a little bit longer in this case. We could go shorter. Well, let's just go shorter. I'm just going to go 25 to 40 days out in time, somewhere in that range. It's got to be something, right? Nope. All right, let's stick with 49. Oh, I'm sorry. Got to change it off of September, ladies and gentlemen, don't I? All right, so I'm just using the in-the-money search here to see some numbers. Let's just change it. So it'll be closer to what you were looking for. There we go. And okay, I'm going to use UAL 8943, selling the 6th of September 87 call for 410. About a 5% downside protection with a 2.3% of a sign, but hey, that's close enough. Why am I looking at a position that's not related to what David's doing? David didn't tell me which stock, but David, that's okay. This is what structure you likely would have seen, the risk-reward profile of your position you would have seen 4 weeks out, 35 days out. And what I'm looking at here is I've sold the 87 call. My break even is 85.03. That's my 4% downside protection. In this case, it's closer to 5, but that's my 4% downside protection. Now you say the stock fell and continued to fall. I don't know how far, David. That's okay. But it continued to fall. It broke through the downside protection range, through the strike price, through the downside protection range, and continued downward. So what could you do now? Well, you could roll down the position. Okay, as you mentioned, but take a consideration of what you're doing. You're still trying to manage a bullish strategy on a stock that's going the wrong direction. I don't care how many people say it. Oh, you don't care if the stock falls. Just continue to roll down the call. Just keep generating premium and you're fine. There's someone who teaches that. That's what he teaches in his $3,000 seminar, I believe, to manage covered call positions. That has gotten more people into trouble in the years that investment strategy has been going on than it has helped them. There has to be a cutoff. When you trade any strategy, covered calls, bull put credit spreads, what you have to have in mind is a trading plan. Now you have part of a trading plan, David. You look like you're opening positions around a 2 to 2.5% return if assigned, with about maybe a 4 or 5% downside protection on stocks that match your criteria. That's great. But in any strategy, just like we talked about with Ed, sort of, when we talked about would you manage it, how would you account for it, but what you have to have is a true closing point. Now, I'm not saying it has to be at the break even. If the stock hits the break even, you'd still have some time value remaining on the call. You know, you're not at expiration. The break even is only at expiration, so closing it would still give you a loss. You're not at break even at this point. But you have to have a cutoff that even though you took a 4% downside protection, is saying that I'm not going to allow myself to lose more than 7% total or 10% total or whatever numbers you're comfortable with your win-loss ratio that show you success with this target gains. You might be right 65, 70% of the time. Well, if your average return is 2%, then you have to factor in what is the maximum loss I'm allowed to take with a 65-70% success rate within the money covered calls if I'm making 2% to the upside. On those other 30, where do I have to limit my losses to be successful long term? And when that trigger is hit, I think it's time to just get out. Don't overthink it. Don't try to manage it. You're in a stock that's going against you. Chalk it up to one of those 30% that you might lose on over the course of the year with your strategy, based on what targets you're setting in your success rate, and move on. It's really hard to stay in any bullish position, bull put credit spread, covered call, when the trend has changed and starts to move bearish. Sure, it could recover, but what are the reasons that it's falling? Is it because of the broad market? Is because of weakness in the sector with the earnings that are being reported recently? Are earnings coming up and maybe people are fearing a bad earnings, so they're taking their profits out of position prior to the earnings? Those are things you want to consider. And is it worth it to try to continue to move this position down, to roll it down and roll it down, to try just to get back to break even? Because remember, every time you roll down a covered call, you're going to give up upside. And you started with a small amount to begin with. But even if you rolled this call, let's say it ends the end of August 30th, you said 4 weeks out. Say the expiration is August 30th. Even if I roll out to November, what's likely going to happen is I'm going to diminish this return from 2% down to 1%, even if I roll for a credit, because I also have to lower the strike price. I'm getting less back for the stock. And is it worth it to hold something for 100 days just to get back to break even? Or is it better to cut this off at 5, 6, 7%? Wherever the loss is. And if you're at 12 or 15% loss, yeah, you might want to consider management at this point to try it to. But remember, in order to roll, you've got to roll much further out in time. So example, what happened in this UAL position? Let's say a little bit halfway between now and expiration. The stock drops to 85. I let it go to 85, below the break even, below the short call, and I still have 2 weeks left to expiration. So let's say, yeah, right around 821, the halfway point, the stock drops to $85. Now I'm going to get some good decay on my call. But in this case, it's still going to cost me, in theory, $111 to buy it back. And I'd have to roll maybe down to an 83 call, 2 strikes below where the current stock price is. So if you look at it now, if I go out to November right now, oh, there isn't a November in the series. I apologize. If I go out to December right now, the 2 strikes in the money is about 740, 750. So if the stock's at 85 and I'm trying to sell the 82.50, I might only be getting 695, 720 because some time has passed. So what would that do to my position? Well, remember, think about it this way. In this hypothetical situation, stock fell to 85, halfway between now and my expiration date. We saw theoretically it would cost me $111 to buy to close this call. It would still have time value remaining, and the stock's at 85. We're working on a base assumption that if I roll down to the 82.50, take off 10, 15, or 15, 20 days here, so it's only 120 days left, that selling the 82.5 call might only give me about 740. 87.5 is about $2 in the money now. If the stock was 85, the 82.50 is about $2 in the money. So we can assume it's around this price with some time decay. I'm going to call it 720, right? So if I roll down here, remember my original expected profit, if assigned, was 2.3. If I roll down, I'm keeping a lot of premium here. I'm keeping almost $3.30 a premium plus 720. I'm getting an extra 10, but I've lowered my assignment cost by 5 points. So the return does go up to 3.7% for 120 days. You set a target. Your example, David, was a target of 2% return for 30 days. Rolling down has moved it from a potential loss to a profit of 3.7%, but that's only an increase of 1.7% of what I expected, with adding 90 days. So I'm nowhere near my target plan of 2% every 30 days for positive return. this works out to only, what is that, 17 divided by 3? It only works out to be about 0.6% each 30 days for the next 90 days to move out to the December call. Does it match your trading plan long term? It could stop a loser from being a winner, absolutely, but it's increasing the time. You're tying up the capital for that extra 120 days or so, 90 days or so, and it could turn a loser into a winner. But if I just took the 6 or 7% loss now, how many other trades could I make, 2 or 3, that are getting me the 2%, 2.3% return that I want and countering that, rather than going out here looking for 1.7% return? That's the trade-off you have to ask yourself. And if the loss is too big, you might not be able to roll down. If the loss is too big, David, and what do I mean by too big? I mean that if you're at 15%, 16% loss on the position, you're not going to be able to roll down effectively. Okay? In that case, it's going to, not give you the return that you're really looking for in that situation. So one thing you might want to consider is buying back the call now, David, and then you could evaluate. So in this case, I'd buy it back for 111. Let me just clear that out. If I bought it back for 111, my cost basis would be 86.14 on a stock trading at, let's say, 85. Well, then what I would do is I would just go to the stock repair tool. Now, our stock hasn't dropped yet. It's sitting right at 89. But let's say that I paid, after selling the call and buying it back, my cost basis was 94 for 100 shares, 5 points above where the stock is now, excuse me. And so what the stock repair tool will do is to try to build you a ratio repair where you might only need to see a small gain up to 91.39, even though your cost basis is 94, to get back to break even. Okay, so if your loss is in that 10, 12, 15% range, this one isn't. I know it's a smaller loss. If I went up to 98, where we're down about 10%, it has to go out to December to find details, but rather than waiting for the stock to come back up to 98, where it's currently at 89, I'd only need it to go up to 91.63. And what, of course, the stock repair tool does is it builds a ratio call spread to help you get back to break even. Really what it is a bull call debit spread where I'd buy 187.5 call and sell 292.5s. But 1-to-1, that's a bull call debit spread with a covered call. Now see here, it's a small return of 1.8%, equal to rolling the covered call down to the lower strike price, but I'd need only a small movement up to 91.63. Okay, you're still well below and repaired, so it has their pros and cons, but it's only a 1.8% return at expiration. About the same of rolling that deep in the money call, even further in the money in that case. So it's a pro and con, but if the loss is up 10%, remember, we only looked at the UAL example, the theoretical example, if it had dropped from 89 down to 85. That's only a 5% drop. If you're looking at 10, 12, 15% drop, rolling down means you're rolling too far to the next lowest strike price, where you might not even have a profit, even though you're collecting a lot of premium. That's where the stock repair might come in more handy in that case. So first step, David, is evaluate the numbers and see if it matches. I showed you that roll wouldn't match mine. If my target was to make 2% on my winners every 30 days, rolling it down there only increased the gain to 1.7% in our example of a 5% drop on the stock with the in-the-money call. It was a 1.7% gain for 3 months, or about 0.6% per month. That's well below my target goal of 2%. Depending on where the loss is, I might just take the loss and then move on. Okay, now, Ray's been patient. That's my in-the-money covered call discussion. Rolling the in-the-money covered call. I'm sorry, so first, look at the numbers and see, does it make sense or does it totally ruin your trading plan and goals? Okay. Second, analyze the stock again. When you open the covered call initially, you thought that everything on there would be neutral to bullish, that you'd get assigned and make the 2% return. Something's happened. It's not anymore. Look at the stock with completely fresh eyes. Don't consider yourself that you have a losing covered call trade or a losing bull put spread, a losing long call in it right now. Look, before you roll down, look at the stock, look at the chart, look at your technicals that you use, your fundamentals, whatever criteria you use, and then ask yourself, would I open a covered call on this stock today if I saw it for the first time? If your answer is no, then you may not want to consider rolling the position, because your losses can still compound if it keeps going down against you, even with rolling down further and generating more premium. You can get trapped. So if you look at it and say, you know what, I would never open a covered call or a bull put credit spread on this stock right now if I saw the chart as it was today, maybe don't roll your covered call down. Maybe don't roll the bull put credit spread down. Maybe take the loss. We don't like losses. We don't want to admit to it, but just move on. And if your trading plan has been working for you, in 1 or 2 months after a few trades, you'll probably make that loss back. Okay? But analyze the stock. If you think it was market related and the stock's going to recover, it's not due to sector weakness or weakness in that stock, then hey, you can roll down. It might work for you. It would probably give you, might give you even a higher profit, as we saw, depending on how far the stock has dropped. Usually when you're down 10, 12, 15%, you're rolling the call down too far, meaning you're lowering the strike price of assignment down too far, where it counters the premiums you're collecting, and you still might be at a loss or only a small gain, as we saw, 1.7% increase for 90 days extra. Okay. Ray's question, the power options portfolio. And Ray, I'm assuming you're talking about how to just set up a portfolio to start putting in your trades rather than setting up a portfolio of trades, meaning me not telling you how you should structure your portfolio with what trades and what percentage in each. Your question seemed designed to just set up the portfolio. Okay. So Ray, if you can clarify that for me, that you're just asking about setting up the portfolio to get started. All right, so here's how I would get it set up. I'm going to throw some quick numbers at you. I'm going to try to draw them on the screen. Let's say right now, one of my retirement, I won't say retirement, I'm thinking about it now, and yeah, it's still 20, 22 years away, thankfully. In any case, let's say I have an account. I've been trading it. I have an IRA account that currently has a total market value of $28,000. Okay, so here you go. You said you're holding 11 positions, 21 years to 3 weeks old. Okay, holding 11 positions. Okay, so I think you're just talking about how you'd set it up to track the positions in the portfolio. So let's say I have an account, and right now my account with my 11 stock positions and cash on hand is $28,640. Okay, now, when I set up a new portfolio in PowerOptions to mimic what my actual account is, what we simply do is we click on Setup. And this shows me my current cash on hand and starting basis for other portfolios, but I'm creating this new IRA at Fidelity, for example. Now, even though my total account value at Fidelity, if I liquidated everything, all of my stocks is $28,640, I could say, well, I've got $22,000 of that tied up into small shares of these 11 stock positions, and my cash on hand is $2,200, whatever it is. Okay, so, but I don't want to do that. When I'm starting the portfolio, Ray, what I'm going to do is put my cash on hand at $28,640. And I'm going to copy that over to the starting basis. And I might change the starting basis date. And you said positions 21 years to 3 weeks old. Okay. So I might put the starting basis back that far, but it really doesn't count. All right. I might just start it at 1/1/2019. Okay, because you know the cost basis of all the positions in your portfolio, the stock positions in your portfolio that you've been holding for 21 years. And that's what I might use. Okay, so let's save all changes. Now, that just saves it. What I do now is I go to portfolios, and here we are. I'm in my new IRA at Fidelity that I haven't started recording in PowerOptions. I've got a zero gain and loss because my cost basis, I'm sorry, ladies and gentlemen, my starting basis is equal to my cash on hand. Why did I start it that way? Is because now I'm going to put in what I paid for the stocks. And each time I put in what I paid for the stock or the covered call or the bull put credit spread, it's going to adjust the cash on hand to now accurately reflect. If I'd only put in a starting basis of 2,200 or cash on hand, excuse me, of 2,200 and then started adding the stocks, well, this would go negative very fast. So put in first the liquidation value of that total portfolio, your cash on hand plus the value of all your stocks. The liquidation value, that's what you start with. And now, 5 years ago, okay, I put in long stock, Ray. And 5-6 years ago, I bought 100 shares of Apple for 101. Okay. Now, what did that do? That lowered my cost basis by the $10,000. For the call, or $10,100 roughly. It lowered the cost basis down, so now I'm still accurate accounting it. And I've got a 36% gain on the portfolio, but 102% gain on the Apple position. Okay, let's see. Now I also entered in Planet Fitness 3 years ago, 100 shares, when it was only at $26. I think that's what it was when I traded it as a married put last year, wrote it up to about 35, didn't get back into it, should have, because it's bloody at $76 now. Okay, but there you go. We've got the nice run there. And what happened? Cash on hand lowered again by that extra $2,600. So I'm seeing an accurate portrayal of my positions and my return on my portfolio as well. Now, if I've got two positions that are returning 194 and 102%, why is the portfolio gain only at 53.6%? Well, because that's only on half of the portfolio. Right? I've only used $13,000 of the total $28,000. I still have to account for my other positions. And occasionally we're in a bad spot. Occasionally we are in I forget what that price is, but I'll put in Trex. Let's say I bought 50 shares at the peak, let's say a few months ago, when it was at, oh, no, 88.60. All right, now this is going to take out another $8,000, right? We're still lowering it, and I'm at a 10% loss on this particular trade. So, Ray, that's how you do it. Do the setup first. Put in, to start, the cash on hand equal to the starting basis, which is equal to the liquidation value of your portfolio. Then once it's created, start going through and adding your positions with your cost basis from your initial trading date. And that cost basis, don't even worry about historical trades, covered calls you sold or closed or rolled or anything like that. Put in the current cost basis as it is right now, factoring in what you know in your brokerage account of all of the gains and losses you've taken from options trades against it, if in fact there were any options trades against it, or lowered by a dividend, for example. And then just add in your 11 positions with your original purchase date and what your current cost is now, and you'll have an accurate reflection of portfolio performance, cash on hand, based on not your true starting basis, but that's not really what we want. We want to reflect it on the starting basis of when you started tracking the portfolio, which was sort of equal to what the liquidation value would be if you would have closed all those 11 positions plus your remaining cash on hand and then taking them out of there. Okay, that will give you the accurate depiction, and I feel an accurate return of what you're trying to track. So, Ray, that's how you set up the portfolio. Remember, too, in addition to that, and just keep adding in the positions there, and you can start tracking them. Remember, too, you can click on the Help Videos link here once you're in the portfolio at any time. This walks through the portfolio setup exactly as explained. Yes, it's an older video, but it shows exactly why I choose to use the starting basis equal to the cash on hand and set up a starting date that I want to start recording the positions on from the portfolio beginning, or you could just use today if I wanted to. That doesn't really necessarily matter. But then entering a new position is the second step, then setting the alerts and set up an email, position analysis view, for evaluating rollout opportunities, how to simulate your own rollout opportunities manually, and how to enter historical options trades or stock trades if you want to. The 5 quick 4 or 5 minute videos there that walk through kind of what we did in the first step 1 and step 2, portfolio setup. Whoa, didn't want to do that. And then entering a new position. Okay, That's always available for you there to take a look and review, Ray, whenever you need to. All right. Let's see here. Okay, Sam's got a opposite covered call, sort of what was discussed earlier. He's got SPY, but with a cost basis of only 211. He sold the 300 call, of course, which is out of the money. So he's just waiting for that to decay, and he's not worried about it because he got a cost basis of 211. Dividend was 140. That's good. I saw that kind of increased a little bit. Okay. All right. Oh, okay. And Sam says he sold the 300 call in his SPY position when it was at 302 because he saw the downside. He was projecting a downside move was greater than the downside volumes were greater than the upside volumes. So he did it for downside protection, just as David had entered his for 4% downside protection. Okay. Okay, and then you mentioned another trade that worked out for you, but is kind of dangerous in that sense. Okay, and what I mean by that is that Sam says that he was in SQ. Oh, let's just go to the... Oh, that's weird. I don't know what happened there. Did I get timed out? Very strange. Ah, there we go. Sorry, Sam was in a bull put on SQ where he had sold today's expiration, I believe you meant, Sam. And I'm not clear on that. There we go. But I'll just mimic it 7 days out because I don't want to use the options today. You were in a 75. Wow. You're in a 75-73 bull put spread, which you did some time ago, looks like. Just going to put in a 20-cent net credit here for about 11% yield. All right. So you had the bull put, but you said when the stock was right around 74, 70, I'm sorry, you were right around 76, I think you said you bought the short put back for a loss, but left it open. And of course, with the stock down to 69.60 today, that worked. Yeah, that's one of the 8 ways I talk about to manage a bull put spread. Again, for those of you that are interested, that product is going to be coming out shortly, definitely by the end of August, probably by mid-August. But my full thoughts on bull put credit spreads, what I do, what to approach, what criteria to use, and more. A full online product there with the 8 ways to manage the bull put credit spread. One of them that I do mention, sorry folks, my chart's not drawing for me. I not move the cursor until I think it's done. Hip hip hooray. But if something starts to move against you, naturally, as Sam did, he moved it here before this decline came down. So he essentially just had the long put with a higher cost basis because the extra price to buy back the short put option, and now he's in a big profit zone. So excellent. But one of the ways to manage a bull put, if the stock starts to come down and threaten the short put, is to buy to close the short and leave the long open. And I typically only do that if I have maybe 8 to 10 days or more to go to expiration, because it needs time for it to continue to move down. You had a great jump on here with this decline today, Sam, so that really worked out for you. I would rarely do this with only 1 or 2 days remaining to expiration unless I had an event coming up that I was very bearish on, meaning that earnings were coming up and I was bearish on them for the stock and they were coming out Friday morning. So Wednesday I bought to close the short put. But again, what's the worst thing that can happen? Well, it goes back up and you realize the full loss, which was the initial cost of your bull put minus the premium you took in plus the buyback cost. So this might be a significant loss, probably equal to what the bull put credit spread loss might have been at full loss as well. Okay. All right. Ray asks an interesting question. I'm going to mention it now, and then I'll mention it at the end again too. Ray asks comments. He said, I think this will answer my question, particularly after I can watch the recording, which when next week. Actually, I am going to have this webinar up sometime late tonight. You'll receive an email tomorrow morning that it's been posted and it's available. Why am I doing that? Well, I'm probably going to be up till about 2 in the morning doing it. The reason why is that my vacation starts tomorrow. So I won't be around at my computer next week to adjust and edit the videos you mentioned, Ray, and then post it up on YouTube and on PowerOptions. So I'm actually going to do that tonight, so it's available for you guys early, so you'll have it for next week. There will not be an open discussion next week because I will be on vacation. I will also not be in the office to help you with email questions or call questions. Ernie will be able to handle all of those, and Greg as well as always. Okay. All right. Sam says he does that because of the Terries, T-E-R-I's. Good, good. Okay, great. The tariffs. I'm sorry, tariffs, Terries, not tariffs, Terries. It's autocorrect on both ends. Yes, because of the tariffs. Good call, good move, worked well. Dell destroyed me today. Didn't destroy me, but it leads into Asotush's next questions. How do you fix a married put in which the stock has gone down 10% and the put is far in the money? Well, that depends on your outlook. That's sort of what's discussed in the blueprint, the 12 ways we manage the married put position, whether there are ways of those 12 income methods. Some work if the stock's up, some works if the stock's stagnating, and some work best if the stock has fallen. You want to analyze what the situation is, and you can use different adjustments because you said the stock's down 10% and the put's far in the money. Well, it gained for you, didn't it? One of those is a gain. The put isn't just insurance, it's a second working asset that you can manipulate to restructure the trade, lower the cost basis on the position, lower the break even on the position. Okay, there are ways to manipulate that put. Income method number 9 in the blueprint is discussed. A combination of 9 and 3 is discussed as well. So those are some ways that you can do it and get back to break even. One of my positions, I did that with recently, Trex. I'm not going to show the specific income method here because that's what the blueprint's for. But I'm going to go to Trex. This was a fun one. This was a married put I was in. Let's go to big charts here. I'll pause the screen for a second because I got to find the other tab real quick. Oh, there we go. Okay. And, oh, I didn't sign in. Let me sign into RadioActive Trading. I know, you're looking at the same screen. You're not seeing what I'm doing here. That's quite all right. All right, so first things first. Are you still looking at the chart? Yes, you are. Good. Shoot, I didn't want to. Okay, sorry, folks. I got into Trex 150 days ago, 5 months ago. I liked the stock at the time, and this was a lot of fun to trade, this one in particular. I'm not recommending anyone trade it, but this was a fun one to trade. Okay, so I got in, I think, right around here. Maybe not even that far. Maybe it was here, but it was around $72 per share when I bought in. Okay, and it had some movement up. It had a decline. It hit $58 twice and back up to 75 once, and then, of course, up here at the end. But, you know, when the stock went down here, I did that adjustment I was talking about where I lowered the cost basis on the position. So when it recovered here, I was actually at a profit, even though it was only a couple points above where I originally purchased it. So when it fell again, I did it once more. I made a move, used that second asset, Asotush. It's not just insurance, it's a second asset working in my favor. And so I used that again to lower the cost basis on the position, still leave a married put, but now with a lower cost basis because of the profit value on the put, restructured the trade. So when the gains came back, I was at break even actually here when the stock was still trading at the original price. Okay. And with the gap up from earnings in this case, when it happened, I was able to get out of the position for a 7% gain. Not fantastic, but it's my target goals for a married put, isn't it? On average, I'm looking to 1 to 1.5% per month. I was in this for 5 months and got a 7.1% return. So it's around 1.2%, right? A little bit more than that. 1.4%. Yeah, 1.4%. My apologies. So 1.4% gain per month, right on target for what I'm looking for. And so here's the track record here. Let me clear up those drawings for you, everyone. And there it is, the Trex company there. Look here. Because of that adjustment I was talking about, talked about in the blueprint, which helped me lower the cost basis, take advantage of the put as my second asset to restructure the trade, the stock was only up 5.6% from where I originally purchased it at $72. But I had a 7.1% return, and that includes all of the put costs as well. A few details here. So there it was, income method number 9. I did a double combination there on the put, which went deep. And yeah, I originally purchased the stock. I'm sorry, I was way off. I thought it was 72. My apologies. I bought it at 76.71 and closed it when it was a 78.85. It's only up 5.6%. Because of restructuring it, though, I made 7%. Now, what you're missing on that basic thing that I can't give away everything for free for, that's what's in the blueprint, is that I made that decision because I had the feeling that Trex was going to recover. If I felt Trex was going to continue down after it hit that $60, $59, $58 mark, which was actually related more to market conditions and tariffs at the time, I would not have done that particular income method, even though it worked out. If I didn't think it was going to recover, I would have closed the position, maybe just closed the stock and left the put open, or done another structure, income method number 12, to profit to the downside. So that's what the 12 income methods are. That's what's described in the blueprint to help you adjust the position if the stock has moved up, if the stock has moved down, or if the stock's stagnating. But I don't do it just because the stock's down. Each income method that's discussed has what is called a SIGA model that Kurt created, or in some cases I created. Really Kurt did, but for income method number 12, I sort of penned what I thought were the SIGA model for that one. It's irrelevant. In any case, the SIGA model for each income method is described. That means, what are the conditions to use this income method? What are the expectations for you going forward with the stock? That's going to help you to see if this income method meets your goals, and that determines your actions. If any of those three, the current conditions, the expectations, or the goals, aren't being met, then don't use that income method. Look for something else. Okay? All right. So that's what we talk about there. That's how you can look to adjust the position. You can use that second asset to manipulate it, Asotush, and help you lower the cost basis and lower the break even to get a rebound on it. Or there's another adjustment if you think the stock's going to continue to drop down in price against you. All right. Okay. So this last comment from Sam. It says, I was in beyond 185, 180. After earnings, the stock rallied to 200, but the next day news came out. Secondary shares, the stock expected to be at 160. You got out at 179 with the 185, 180. Took a loss of 500, but made that money on the SPY puts, which was a loss of 200. Okay, good, Sam. And that's one thing. What Sam's saying is that he got hit on his bull puts one of his bull puts today on BYND because of the tariff talks, but he had puts on SPY, so that countered it. As many of you know, and I apologize for sort of forgetting this. It wasn't Ray, it wasn't David, it was Binh. I'm sorry, it was Binh. When Binh said the VIX is high. Well, yeah, VIX is high-ish right now. Okay, it's high-ish right now. It's been higher even in 2019, I think. Yeah, so we jumped up to 22. Remember when the first recent tariffs have came up, we flirted. It jumped up to 20. It did hit 20 today, didn't it? Yeah, but it's settled at 17. Now it's been at that 17 mark several times. Okay, pen, please. Thank you. So we're right about here. It hit that in this area here. Obviously, this area here. It flirted with it. It was here and here. So in the first 6 months or so of the year, we've hit it 1, 2, 3, 4, 5 times. High to me is 20. Long story short, what Sam's talking about is he had puts in SPY, which helped hedge it. I have calls on the VIX that I bought down here when it was flirting with when it was just below 13, 12.50, I bought the August 16 calls on the VIX for around $1.10, just a few contracts, about 4%, 3% of my total portfolio. So with the movement today, thankfully, most of my bull puts were far enough out of the money. I only had one expiring today. The rest of them expire next week that I have open. I have about 3 more open that expire next week. One that I still had open expired today. Thankfully, it was still deeply out of the money after the movement up before the decline today. But I have those calls in the VIX because in February 5th through 8th of 2018, when that big crash happened, in a day, I hit a 65, 75, and 52% loss on bull put spreads that were profitable the night before. But I had 8 calls on the VIX going a month out. Yeah, it was March. They were out to March. So the gains on the VIX calls countered all of the loss I took on the bull put spreads, which were about 5% each of my total portfolio. So it didn't hurt that bad. But yeah, I closed 2 of the 3 and then closed the other one the next day and had my profit in the VIX calls to counter that. So the portfolio is fine. Then married puts and still had some calendar spreads and collars open too. But in any case, that's why Sam uses puts on the SPY. It's why he also buys shares in UVXY. I tend to use the VIX calls. Either way is a good idea to put some extra protection in your portfolio for what do we call the last 2 years, ladies and gentlemen? The headline news driven market. Anytime any new headline comes out, it seems we're going up or going down quickly and bucking a trend where we were comfortable with for 2 to 3 weeks, 4 weeks, 5 weeks, and so forth. So yeah, that's a tough one. Yeah, Sam says he sold his UVXY at 29, but he bought it low at 24. Yeah, and then we talked about that a little bit ago. I sold half of my VIX calls today, not at a great price. I didn't catch it when it jumped up to 20 at the very open, I believe. I got out around this price, I'd say. 17.40, I think, is when I got out of my calls for profit. But I only sold half. I'm keeping the others just in case there's more movement tomorrow. But that helped with some other, even though I got protection on the married puts, that helped with some there as well. Okay. All right. Well, ladies and gentlemen, we are at 5:48 p.m. Eastern Time. I do not see any other questions coming in or comments. There we go. So just want to remind everyone, of course, that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Options do involve risk, may not be suitable for all investors. If you haven't done so already, like some of the tools you saw today, we looked at the profit and loss chart, of course, the custom spread tool. We talked about the search tool for setting up searches for bull put credit spreads or other strategies as well. And of course, we looked at setting up the portfolio to track and manage the positions, and you'll be able to link when you're tracking and managing positions to what's called the position analysis tool, which will calculate potential rollout opportunities for you where all the math is done. You can test all those tools out for free, no billing required, no credit card information. Just go to PowerOp.com, put in first name, last name, email address, and you'll have a trial for 14 days. After that, the subscription levels, monthly subscriptions start at only $45 per month, but we do offer higher level services if you want real-time data or the inclusion of real-time data and our history for back testing. And our historical data we record ourselves, and it goes back to 2006. So 13 years of trading data. You want other free education, remember you can go to the blog anytime, blog.powerop.com. As mentioned, we can go to the webinars page as well, powerop.com/webinars.asp. There will be no webinar next week, August 9th. We will be back on August 16th, standard expiration day. But today's video will be archived, will be posted likely early this morning, but I'll send I'll schedule an email to send to everyone tomorrow morning at around 9-10 a.m., letting you know that it's been posted. You can probably see it on the webinars page or on our YouTube channel as well. If anyone thinks of any other questions later on, remember I'm not going to be available, but Ernie, Greg, and the other staff members will be more than happy to help you out. Just send an email to support@powerop.com or support@radioactivetrading.com. You can also call the office during market hours at 302-992-7971. And of course, if you are a trial member or a subscriber, you can schedule one of those coaching sessions at any time. All right, now I guess that's it. Sam has another comment. I always look for lower price in UVXY. Now I'm going to wait for SPY to make a new high. That's the time I'll accumulate, UVXY and wait for a nice spike. I'm probably going to look, keep my other half of VIX calls that I have and look to buy in similar to what you're saying, Sam, when the VIX drops back down maybe to 1275 or 1250. If it's below 13 and I'm edgy, I might do it then, but it depends, as you mentioned, if the other factors there, if SPY gets up to a new high and that settles the VIX down. So if the SPY is at a new high and the VIX is at 1320 or even 1350, maybe even 14, I might be tempted to buy 17 or 18 straight calls out to September or October. We'll see, but always good to have that. All right, ladies and gentlemen, have a fantastic weekend. Thank you all for joining me today. Thank you for your excellent questions. I'm going to work right now on starting to convert the video, maybe break it apart in a few pieces there and get all of the pieces posted for you so you'll have it over the weekend and for next week. Take care, everyone. We'll see you soon. Good night.